Kate, who do you have for me?
Yeah, we've got Anthony Battista.
Anthony, can you hear me?
I certainly can, John. Thank you so much for having me.
All right, I can see you, the man who makes black looks good, uh,
Try.
best known as the Bat, Tony Battista, co-host Tasty Live every morning with Tom Sosnoff, and brings you live trading commentary, daily market research, and actionable trade ideas. You can watch Tony hone in on Tasty Live mechanics in the short video series Trade Hacks and Bat the Mechanic, or jump into teaching trading basics in Where Do I Start? Back to Cool, and Where Do I Start? Bat versus Bat. He also appears on the trade talk shows, IRA Trading with No Strings Attached, and How to Use Option Strategies and Key Mechanics. Check out Tony's podcast, Option Trades Today. You have until 5 minutes before the hour,
Fantastic.
and I look forward to hearing what you have to say today, these are such interesting times. And I'm going to go ahead and mute myself, and you have the floor.
Thank you, John. Appreciate you allowing me to talk to all your mad traders that you have here. As John said, my name is Tony Battista. I am an ex-CBOE market maker from the floor of the CBOE from around 1983 to about 2005 or so. When I left the CBOE, I was an independent market maker. I only traded my own money at that time. I've only traded my own money throughout my career. I started with around $5,000 in 1983 as a market maker on the floor of the CBOE, but times have changed. That same point of entry now would probably be closer to $500,000 or more to get involved in the market. I think as retail investors now with the trading platforms and all the tools that we have, maybe some of the tools that the gentleman just showed you a moment ago, or maybe some of the tools you might find at the brokerage firm that I helped start, tastytrade. You could find all those tools there too, or extra tools that you might like. What I'm going to show you today is really about SPX, the Standard & Poor's 500 cash settled index. I traded the OEX back in the day, which was the OEX 100, the 100 most capitalized stocks before really any ETFs or products like that were available. It was the most widely traded option product at the CBOE for many years. Now the SPX has obviously taken that title away from the OEX. I don't even think people trade the OEX anymore. But what am I going to show you? I'm going to show you 0-day trades in the OEX that we would consider making. I'll put my platform up there for you right now, and hopefully you can see that. I believe that you can. So what are we going to look at here today? One investor's floor is another investor's ceiling. So we're all judged, or have to be judged, by how much money we have in our account and the different strategies we can use. Every strategy I'm going to show you here today can be done in an IRA account. It will take, sometimes it'll take considerably more money than a margin account. I will be using a margin account for today, just a regular margin account, not a portfolio margin account. Portfolio margin account, at least at Tasty Trade, is over around $135,000. You get special or extra relief on your trades that you put on. An IRA account, you can sell naked calls in at Tasty Trade, whether it be an SPX or IBM or NVIDIA or any other stock that you might want to trade. I know some brokerage firms, or probably just about every other brokerage firm, do not allow you to sell naked calls in an IRA account, but we do at Tasty Trade. So check us out. That's my big pitch for Tasty Trade. What are we going to look to do here? Again, 0-day options, trying to use as little capital as possible. I'll try to take you to the highest amount of capital trades that we would put on. And I am doing this presentation at 1:05 Central Standard Time. We prefer to put these trades on earlier in the morning, slightly after the opening from our research, and at Tasty Live.
That's
tastylive.com, where Tom Sosnoff and I do a show every day. We like to do these, and our research has suggested to do these earlier in the day, and look to take them off before this time, around noon in the afternoon. Now, we have done research that shows if you hold these through the end of the day, you do make more money, but your P&L swings will be a lot greater. It's a lot smoother path, albeit less profitable, when you put these on earlier in the morning and take them off before noon. Noon's not a magic number. It's just that it seems like, as you've noticed over the last couple of days, the market has made some violent moves at the end of the day, and the strategies I'm going to show you want the market to stay stagnant for most of the day. Now, before we get to the SPX, we have to talk about /VX. /VX is the volatility index that I like to look at. I'm not a VIX follower. For me, VIX is a poor indicator for daily volatility changes. VIX is a product that is really binary. Its price expires to that number at expiration. /VX is what volatility is doing today. It's up 17 cents. It's up small 1% today. You can see it's trading at 13.85, but you'll notice that it's been going lower over the last couple of days, months even, into this market. Volatility is going to have to spike before we get any downturn in the market. Over the last day or so, meaning a little bit into yesterday, a little bit into today, you can see volatility has been upticking ever so slightly, but not really a lot for concern for the market going any lower right now. So for me, volatility, when I'm looking at, is /VX. I prefer to put these trades on when volatility is expanding, hoping that volatility will contract throughout the day, one, or two, the market stays inside its expected move. Now, the expected move for SPX is important because we have to learn about a standard deviation. We want to stay in, and on the Tasty Trade platform, it's in parentheses here, we want to stay inside that expected move. Presently, that expected move is just about $11, $10.96. You can see the expected move over here, 1 day, June 5th options, is just under $29. Let's call it $28.50 from this moment until tomorrow at 3 p.m. Central Standard Time. I'm in Chicago, so I'll use Central Standard Time. You'll have to adjust for your own times. So to know what the expected move is in a product is very important because we want to stay outside of that expected move when selling premium. Now, if I was a premium buyer, I'd want to be inside the expected move. So if you're more comfortable selling buying premium, do yourself a favor and stay inside the expected move. So at least you have a 50-50 shot or better, if you can get the direction correct, of making money. Let's look at these 0-day trades or a trade that you might look to put on today. And again, I'm going to show you trades and give you prices from what the morning would look like, because that's what we normally do, but we can take a look at what they're doing right now. So a simple type of strategy to use in any underline that's liquid, and SPX, as you can see here by the amount of volume on both sides of the market, is very liquid. So you're going to get filled typically within mid-price of the option, meaning if it's 310, 315, you're going to get filled at 310 with the ticking down 1 nickel just now. So for me, what I look to do is I like to go somewhere around that 20-ish delta option, and I like to sell both of those. For the first thing you'll notice here, when I go to the 20 deltas, the 52.65 with the stock at 52.78, we're only $13 away. Let's see what $13 away brings us to the 52.90 to the upside. But yet the delta on that one is 24 versus 21. That means a little bit of call skew. So you have to do a little bit of your own kind of market awareness here. If you're a little more neutral to bearish, you might do the 52.90 call. If you're a little bit more neutral to bullish, you might do the 52.95 call, taking in less credit. But you'll notice the buying power, which is on the right-hand side here, even though this is a delta neutral trade, 5 long deltas. If I would move it down one, it's basically delta neutral with 3 short deltas. All of them have a 67% pop or slightly better, 71% when I move it by $5 to the upside. They're using a lot of buying power, way too much buying power for me, you, or anybody else, in my opinion, regardless of your account size. Now, of course, there are always extenuating circumstances for people, but for me, this is too much buying power in one trade. So what am I looking to do here? I'm looking to define my risk or use less buying power. From our research, $20 wide seems to be the magic number of risk versus reward when placing these trades. So to simply do that on the tastytrade platform, I just have to click on the offer. It turns green and populates a buy, and I'll go $20 wide on the call side. And again, click on that and it'll buy that call. Now you'll notice that my buying power goes down from $100,000 to $1,700 and change. My credit I receive is $2.90. Again, it's going to reflect the options that I'm buying. It's going to reduce my credit by around $60 or so. It does not reduce by much my probability of profit. And if I move it down a nickel, it's not going to reduce my probability of profit. I like to stay at or around a standard deviation, which is that 65% approximately probability of success. This would be a defined risk trade. Any one of the trades I just showed you, you can make in an IRA account. But for me, if I was looking to trade SPX, I'd be looking to define my risk regardless of my account size by buying those wings. $375 in the case that I'm using here. And if I go up one strike just to be more delta neutral, $275 on $1,700 worth of buying power. The theta decay is quite high. It's going to be the credit that you receive in here because this is expiring today. SPX is a cash settled index. What does that mean? Well, cash settled just means that there's no stock at the end of the day that you could be either long or short if SPX were to go inside your short strikes. That's one of the unique things, and quite frankly, one of the cool things about SPX that make 0-day and shorter term options a lot more advantageous for the retail investor, because there'd be no stock left over. Your buying power is not going to change. If this were to close at 5,300 and you sold it at $3, you'd lose $200 and your trade would be over for the day. When you came in the morning, your account might be down, will be down to $200, but you'll have no stock or any other position that you have to worry about. It's a very clean way for retail investors to trade. Now, I'm going to caution, well, here's my word of caution for you. From what I've seen from my experience, most of the traders who are trading 0-day options are undercapitalized. And by undercapitalized, I mean it's those with, $25,000 in their account or less. And they're looking to kind of, make income every day with using a small amount of capital and really kind of embracing these 0-day options. For me, I think it's a slippery slope. I know with a smaller account, because I've started out with one, you do have to risk a lot more than you would in a larger account to be able to stay in the game. It's very hard in a smaller account to be trading in a 45-day time frame, which I would prefer you to do than doing something like this. I get it, but I caution you to be careful with your position sizing. You never realize how big small really is. So keep your size in check. Be able to open your trading doors each day. And you know what? You'll get a lot more experience by trading smaller in these products. I'm going to give you another. That's just an iron condor. We looked at a strangle the first time. Let me see if there's a question or two here before I move on. Look here. Okay, thank you. Doesn't seem like it. But if you have any questions, please type them in. My associate will help me, Britt, answer any of those. And if I miss them, she'll do a good job of telling me what to do. Another trade that we can look at that has a very high probability of success, and one again that we prefer to do in the morning, not in the afternoon, like the iron condor that I just showed you right now, that was trading closer to $2.85, trades closer to $4.50 in the morning. So that would be the type of trade that we would look to put on and take off now, as opposed to keep it moving on here. So you'd be looking to make, $100 to $200 on one of those. Another trade that is going to use a little bit more buying power, but has had good success for a lot of the viewers on our show, is looking at selling those same strikes again. Let's go down to the 20 delta on the put, and let's go up to around the 20 delta on the call. Again, I'm in the 0-day. High probability trade, 74%. Obviously, whatever I sell it for, that's how much money I can make. The buying power is quite large at $100,000. What we like to do is, again, defining that risk by going out to the regular options, meaning either the 16-day or even the 44-day AM settled options in SPX, and looking at the expected move. The expected move, let's just round and say it's $175 of an expected move. So what we like to do is we like to sell those 20 delta options in the front month, go to $175 expected move, which would bring us down to around 51.15. Look to buy one of those, because I'm going to be 1-to-1 call versus call. It's really just a diagonal put spread and a diagonal call spread. You can break these down however you like. And I'll go up by $175 on the July to 54. Let's see. I have approximately, we'll go to, I'm sorry, 50, let's see, 53, 54, sorry. Let's go approximate, just to show you. Really, what you're doing here is you're just trying to use less buying power. So as wide as your account can tolerate is as wide as we would look to go. We go to around, you'll notice it's around a 25 delta on the call, and it's going to be around the 25 delta in the put. Because there's call skew, you could make it a little bit wider if you wanted to make it more delta neutral, bring up your strikes ever so slightly. Of course, you'd be using, you'd be paying less, but using more buying power in this trade. But you'll notice when you put this trade on early in the morning, what this does is it allows you to take a little bit of advantage of volatility expansion. If volatility is so low the way it is right now, by buying those wings 44 days out or 45 days out, or buying them in those monthly options, what'll happen is if volatility expands, again, /VX volatility expands is going to have a direct correlation, or is the measure of XPX volatility. It's usually not going to be in the 0-day options. It's going to be more in the back month options. So what you're doing here is you're buying the July with 44 days back month options. If volatility were to expand, you get a little bit of a bump there. Your theta decay doesn't stop, but it goes down by a significant amount, while your front month 0-day options must go to parity at the end of the day. So when volatility is low the way it is right now, I showed you one strategy, the Iron Condor in 0 days, $20 wide, which uses $1,700. I'm showing you another strategy now that uses significantly more buying power, and you'll notice that there's no probability of profit on here because you can't account for what volatility might do in July, those options that you're buying. But what we're hoping for is that volatility actually stays bid or expands a little bit, so that those July options that we're usually using actually make a little bit of money too. So you've got like a double kicker on the trade. You've got the front month that's going to expire and go to parity. And then you've got those back month options, which you hope will expand or stay bid at least. What do people sometimes do when they're looking at a trade like this? They might look to put on a trade where, as the day goes on, as it is right now, and let's assume that this trade has been working for you, they'll close these front month options and roll them to the 1 or 2 day options and go further out of the money with them. Now, we've done research on this too, and it does seem to appear that in the market conditions that we've had as of late, which has been contracting volatility, which suits these strategies, let's not candy coat this. If we go back to April and you're placing these strategies and we have the type of down move that we had in the market, these 0-day selling premium strategies will not work. Now, if you've been putting them on from January up until April, they were working quite well. If you've been putting them on, in April until now, especially over the last month or so, they've been working quite well. So the market has to accommodate, but that's when your market knowledge or the things that you've learned come to fruition, right? I mean, what you're looking to do here is take advantage of what you've learned, whether it be technical analysis or fundamental analysis or just an opinion on what you think the market's going to be doing. By using the right strategy that has at least a high 65 plus probability of success, you put yourself in a good winning position. There's a question from a Leonard, if I can see it. Let me see here.
You don't have to worry about that one, Tony. That's
Okay.
that's from the previous person that was.
Gotcha.
Yeah.
Gotcha. Thank you. Appreciate it. Is there any questions? Do I have any questions?
Not right now.
Awesome. Either I'm doing a lousy job or everybody's absorbing it. We'll see. Either way. So far,
You're doing a great job.
Thank you. So far, we've only looked at an iron condor. Well, we've looked at naked strangles in SPX, which I think we're going to rule out with 0-day because they use way too much money. I guess you could use SPY, but then you've got that whole stock substitution, that whole stock that you have to, if your options expire in the money, you're going to be stuck with stock. SPX is clean because it's a cash settled product. Okay. Then we went to an iron condor, which was $20 wide from our research. We like to put them on earlier in the morning, sometime before 9 a.m. Central Standard Time, and take them off sometime before noon Central Standard Time. Then I showed you a double diagonal, which is really just a strangle straddle swap, if you want to, or 2 strangle swaps. We're selling the 20 delta in the 0-day options, and we're going out to the expected move, which I showed you on the 44-day options was around $175 away. How did I get that number? I didn't make it up. It's what the market is showing us. So we define our risk. We're able to use less buying power on that. One more trade that I'd like to show you, or an additional trade that I'd like to show you, that's more directional in nature. I'm going to show you with the 1-day options just to be a little bit different and show you, because the day is almost over. We only have about an hour and a half or so left to the day. To show it to you in 0-day options won't be as compelling for you, but maybe it'll be compelling for you here. What I like to do here is a broken wing butterfly. Again, my whole segment here is to concentrate on shorter dated options, shorter dated time frames. SPX is a very big product, so we like to take big products and make them smaller, more user-friendly for the retail investor. So let's just assume for a quick second that you were bullish on the market. I'm saying bullish because we just rallied here. I'll go to a bearish one in just a minute here. But let's say you were a little bit more bullish with your analysis. This is when you come in with your market direction and you don't want to be delta neutral. You want to have a little bit of market risk to a directional size. We typically go to that same thing around that 20-25 delta. Why do we go around the 20-25 delta? Well, I'm going to change volume here for a moment. and put in probability of a touch for you. And you'll notice if something has around a 25 delta, if I move this by 1, you'll see it has about a 50% chance of a touch. Now that's interesting because I want to buy something. If I'm going to buy something, I want to have a 50-50 shot of it touching that number. Why? Because I bought it, right? So I want to have some play in the game. Now, this is a bullish strategy, and I'm using the put side for a quick minute, and I'm buying them. So right now, we have negative delta. But I just told you we wanted to be bullish. Well, I don't want to have a 20% pop either. I want to be over a standard deviation. So I'm going to buy the 25.65, and we'll go, I don't know, $15 wide. We'll adjust it in just a moment to see how the numbers work for us. I'm going to buy one of those 25.65s and sell 2 of the 22.50s. Right now, I have a $60 credit on this. My max profit is, remember, these are SPX options, so it's not a small product, but I have a nice 92% pop probability of profit. But there I am using that big buying power number. So we like to go two times the amount that I'm buying, 52.65 to 52.50 is $15 wide. So we want to go $30 wide and buy the 52.90. So we're basically risking $2 $30 to make one $15. Now, I do want to show you one quick thing here. You'll notice that my delta is ever so slightly long here, which is what we wanted to do. But my trade here that I could put on is a 20-cent debit. I like to do everything for a credit. So I'm going to move it by 1 and change my probability of profit from 17% by just doing this, 17%. My buying power is $1,500 because I bought that 1 out of the money option. I'm going to change it by just dragging it down 1 to an almost 90% pop. And now I'm doing it for a credit of $115 or $120. I'm just going to lock it so that the numbers don't move for you here and we can see everything. All right, what's my max profit on this trade? If you look here, it's $1,120 on $2,400, I'll just round up, of risk. Now, why is that? Well, just like some of the spreads I've shown you in the past, we're buying 1, selling 2. We're synthetically long a $10 wide put spread, even though we have long delta on this trade. I'm buying this to define my risk, use less buying power, but really it's a buying power reduction vehicle. I don't ever anticipate or hope, because I'm bullish, that this 52.50 put is going to be needed in my account to define my risk. Nor am I really looking at trying to make that $1,000 at 52.55, although there is a 33% chance that we touch there. Although there is an almost 50% chance that we touch 52.65, which means that there is a 60-40 against us chance that we could make $500 with the stock going lower, even though we were bullish on the trade. Our break even is down at 52.45. Now it's actually like 52.43.80 if we did this at $1.20 where it was a moment ago. So here's where your technical analysis or your market opinion, or maybe you're just playing the math numbers like I do. You're slightly bullish on the market, and how many times do you put on a trade and it goes the wrong direction and you can't hold on anymore? This would be the type of position where if the market were to go against you, meaning going lower like it did earlier this morning, it would actually start to generate some positive P&L for you because time is going by, theta decay, and the market stopped moving lower, which means your embedded long put spread, even though you were bullish, you wanted the stock to go higher, is catching a little bit of a bid. I like to put on trades that we call here at Tasty Live omnidirectional, meaning that they make money to the downside. They could make money to at least have the opportunity to make money to the downside, the opportunity to make money to the upside if you're correct, and or make money if we go sideways and do nothing, meaning we make $120 on our $2,400 worth of risk in a day. Again, we're just simulating these. This would be a day and a half, or I'm just simulating them for the 0-day options so you get an idea of the type of credit that you can receive. Of course, you can move this in by $5 and collect more. Of course, you'd be using more buying power, but you'd still have a nice probability of profit on this trade. Let's go to the other side for a moment and see if we can come up with a similar type trade that we could do here. Hey, Tony, can we place these trades in an IRA account or only in a regular margin account? Every trade that I've shown you here today, you can place in an IRA account. Maybe you missed the beginning of my presentation. You can even sell naked calls in an IRA account without owning any stock or having any other position in an IRA account at tastytrade. You might not be able to do that at the brokerage firm that you're presently with or where your present IRA account is, but you certainly can do it at tastytrade. If you need the information on that, you can always send me an email. My email address is BAT. That was my acronym on the floor of the CBOE. BAT, that's Boy Apple Tom, at Tasty Live. I am on the media side of the Tastytrade network or the Tasty Live network. So my email is bat@tastylive.com. The brokerage firm is Tastytrade, different entity than the marketing side or the media side that I'm on. All right, let's go to the same type of trade, and no worries about missing the first half of the presentation. It's okay. Let's go to the same side and see what kind of credit we get there. Let's compare, right? Do we get paid? If you're bearish, do you get paid more for taking the risk to the upside, or do you get paid less? Well, let's find out. We'll go to that same 20-ish delta. We'll go the same $15 wide. So I'm buying one, selling two. Let's go the same $30, right? Because we're risking two to make one, but have a higher than 50-50 probability of success. Remember, if you flip a coin, it's 50-50, but I'm looking to get paid more, meaning I'm trying to increase my probability of success into the 60, 70, 80, 90% ballpark with just about the same kind of risk. If it was 2-to-1 here, I'd be using $2,000 instead of $2,500. But because I'm using more buying power, I have a 90% probability of success. Here, I'm only getting a credit of $25. So because of call skew, because we have to buy that out of the money option, and because of the skew in the option to the upside, skew to the upside, because of the skew in the option to the downside in SPX, you get paid more because the volatility of the velocity of the move is perceived to be to the downside. Put broken wing butterflies actually trade more expensive than call broken wing butterflies. So here in my instance here, I'm going $10 wide. My break even is 53.45. I have a 90% pop. I'd be collecting another 20-cent credit. Now you can combine the two trades also, which is kind of interesting because you're not going to be using any additional buying power. So you'd have to be doing 6 legs. Now, at tastytrade, you could do 4 legs at a time. So you'd have to send these at 2 separate orders. What I would like to do is I would put this in at, 25 cents. Maybe I don't get filled. Then go work my put spread, put that in a nickel over the mid price, maybe move the put spread down. If the market's going down, maybe I leave the put spread in at that price. If the market's going higher, maybe I leave the call spread at this price. If the market's going higher, then I would move the put spread down. I get filled on one, and then I'm more aggressive on the other one. I don't know of any platform that allows you to do 6 legs at one time. I believe 4 is the most that most exchanges can accept at this time, but I would assume that that's going to change pretty quickly. But the fact of the matter is the math is the same on the call side. Your max profit on this trade is $1,000. Again, we talked about that there's no stock. You don't have to have any extra amount of buying power in your account. As long as you have the $2,500 to put on the trade, there's no margin in defined risk trades. So as long as you have this $2,500 in buying power in your account, you can place this trade. It doesn't matter where SPX closes because there's no stock, whether it be higher or lower, but a good way of being able to use your capital in an efficient way, especially if you're one of those accounts like I talked to just a moment ago that has a smaller amount of buying power in your account. You have to maximize, your capital that you're using. And I think even though you might do your analysis and say, hey, I'm really bearish here, well, then this call broken wing butterfly would be the one to use. If you say, hey, I'm really bullish here, then the put one would be the one to use. Yes, I know you can make more money the downside with the put one, but I want to have the higher probability of success in the direction that I think the stock is going. So for me here, if there's no risk to the downside, this would be a bearish position. Now, we do have customers who place these trades looking to catch the golden ticket, or what was it, the Willy Wonka golden candy bar, where they know that they're placing this trade, they're a little bit bullish, and they think that there's some sort of resistance in SPX around 53.30. Well, if you really thought that there was resistance around 53.30 in SPX for tomorrow, and you wanted to put on a defined risk trade that could make yourself some good cash and have a break even that's $10 over where you think the extreme move in SPX could be, well, then this would be the type of trade that you might look to put on if you're willing to risk that kind of money, $2,500, on a directional bias. I prefer to pick up the dollars or the $2 in the iron condor that I showed you, or the diagonal spread that I showed you, the previous two trades, than to do something like this. But those who like to have a lot more risk on the table will put on trades like this. Customers will put on trades like this. Again, it's all about risk tolerance. Another trade that you can look at, I'll use the one-day options because it'll give you a little bit better of a view. I showed you the strangle the first time. I'm now going to show you the straddle. So again, you're certainly selling a lot more premium by doing the strangle. I'm sorry, by doing the straddle. You'll notice that you're probably a profit. I'm going to discount this because it's 92 and change, and I guess I could do this. There you go. That's basically synthetically selling the 52.90. Well, now we're rallying, so we're going a little bit higher. But anyway, the 52.92.5 straddle, if there was such a thing. So what we do is we sell the straddle and we go out the same distance that we did before. Could you go to June? We do have customers that go to June. I might prefer for you to go all the way out to July with 44 days. If you're going to use the June options, we look at the expected move. It's right around $100. For the ease of the math, I'll go right to $100. We'll use the June just to give you an example on what it might feel like. You're going to buy one around that expected move. You're going to go up to the expected move to the upside, and that's going to be around 53.95. Now your debit's $925. You're using around $11,000 in buying power, but you have the opportunity to make a lot more money on this trade. Remember, you're going to buy it at a debit, and then you're going to want to remember what's going to happen here. You're looking for these 0-day options to collapse. So for all things like a great case for this trade, let's just assume for argument's sake that these both go to zero. They're worth nothing. This is an extreme example not even unlikely, it's never going to happen, but let's just say both of them go to 0, your June options, let's just assume again, a case here where it's unreasonable, unlikely, and I give it a 0 delta. Let's just say these options stay exactly the same, $17.50 and $19. You're going to be selling this for a higher debit. That's what I'm trying to bring here. So you're buying it. It's very similar to people who like to buy out of the money options or buying premium in any case. You're buying it at $9.20, 30 cents, 40-cent debit, and you're going to sell it at a higher debit. That's how you're going to make money, even though you have a positive theta decay. So your short premium, you're buying something for a debit. You certainly have risk, right? You have risk from 52.95 minus the credit you received all the way down to 51.90 and change. So there's definitely $10,000 in risk here, but you can make a significant amount of money by getting the time premium correct, if that makes sense for everybody. Profit target for these. For the iron condor that I showed you in the very beginning, where, you know, if you're doing this earlier in the morning, you can be able to sell them for around $4 to $5. I'm looking to make around $2, $1.50 to $2 for the diagonal spreads that you're putting on. Those have had around $2 to $6 in success when they work. Again, we like to put them on in the morning. There's trade 2, take them off before noon, just because our research has shown that from noon to 3 o'clock, your P&L swings are a lot greater, more risk tolerance than I want to have. If it's more risk tolerance than I want to have, maybe you should consider the same type of risk tolerance for yourself. We're looking at closer to $6. This type of strategy, we're looking at more like $4 to $8 in profit. But again, you know, if you're going to be able to make $4 to $8, you got to figure you're risking $8 to $16 when things go wrong, right? So what we like to do is we like to have a lot more winners. Managing your winners has been probably one of the most powerful pieces of research that we've done. I remember when I first got off the floor in 2005, and anytime I would speak to someone without having the research that we've had, because it was my experience as a market maker, I made the most amount of money usually near the ends of the day, and I made the most amount of money during expiration. What I didn't realize when I was telling people about my own experience, it was probably detrimental to their trading experiences because they were retail investors. I was a market maker. So the market maker's having the most success, you know, near the end of the day and on expiration, then it probably means the retail investor is not having their best times at those times, right? I mean, you can't have one, you can't have both. You have to have one or the other. And I do want to say one caveat when I'm talking to retail investors like yourself here. You know, there's not a market maker, not a good market maker that I know, who didn't want the retail investor to make money. Now think about that for a moment, because that might sound a little bit different than what you hear from other people tell you. As a market maker, I wanted every retail order that came into the pit to be a profitable trade for you, the retail investor. Why? Well, I didn't want to trade with other market makers in the pit. My job, or my being on the floor, was to take that edge between the bid and the ask and try to make $1 with that. Not figure out the market direction, not be a cowboy or Indian YOLOing it just to let the market, you know, go where I thought it was going to go. My job, and again, I didn't have a boss, it was just for me, was to make that bid-ask differential. Now, when I first started trading, the bid-ask differential was, you know, $30, $40, $50 wide. When I left the floor, it was a nickel wide. So it became a lot harder to make money on that bid-ask differential. And you had to hold a lot larger positions, especially larger positions overnight. But if the retail investor didn't make money on the trades that they put on, then they don't come back to my business. It's just like a candy store. If I'm selling candy every day and I don't sell, if I charge too much for my candy or if I sell stale candy, they don't come back to the candy store anymore. Well, then my business dies. And the last thing I wanted was for my business to dry up. So every good market maker that I've ever met wanted every retail investor to be wildly successful, because if you're wildly successful, that meant I was going to be even more successful. And ultimately, that was our goal. Any questions? Let's see. How far out do you out for this broken wing, butterfly wing? I go as far out as I can to collect a credit. What they're talking about is the broken wing butterfly. You know, I know we're supposed to be talking about 0-day options, but you could put these pretty far out in the 44-day options. I like to go to the monthly options. Again, same type of time frame, and you can get pretty wide on these. Let's use round numbers just to do it. 5150, 5100. We'll do chew, and I'll go $100 wider than that, so it'll be 4900. See what this trade's for. Okay, so here's a trade where you have, again, you can move the numbers and cut it in half to $7,000 or put it into quarters and use $3,500. But just to give you a wide, same type of probability of success in a different time frame, 44 days, and I've only got about 10 minutes here left. So look at what I'm trying to do here. Your max profit is $5,700, let's just round up and say $50 here. I'll move it. $750. You're basically risking 2 to make 1 with an 87% probability of success. If you're risking 2 to make 1, you're usually going to have a 50-50 probability of success or slightly greater than that. Where is your break even on the trade that I'm showing you here? It's down around 50-45. 50-45. Let's just look, for argument's sakes, when was the last time SPX was down around 50-45? Was back in April. So if for the next 44 days, you don't think we're going to make new lows in SPX, and you want to get paid $750 for the risk or tying up to $1,400 in buying power, plus you have the chance at $5,100 to make $5,000, again, cash settled, no stock that needs to be done. Maybe you have a portfolio that's bullish and you don't want to get out of some of those positions. This would be the type of position you might want to put on that enhances your downside risk. Because as we go lower, this put spread that you're long is going to collect a little bit more juice to it. And that embedded short put spread that's further out of the money, that has, you know, a 20, 25, 30% chance of a touch, will collapse over time. Again, if it's 30% chance now, as time goes on, that's going to go much lower. So I hope I answered your question there. To ask it one more time. If I didn't, I apologize. So for the broken wing butterflies, how far do we go out? I usually put my buy price, my buy strike at around the 20-ish delta, and I like to risk 2 to make 1. Sometimes during the day, like late in the day, like today, I'd have to move it by about $5, risking a little bit more than 2 to 1. Thank you, Gordon. Appreciate the acknowledgement there. Thank you. Again, I'm B-A-T at tastylive.com. If you open an account at Tasty Trade, open, move, or bring your account to Tasty Trade, they'll give you some cash for bringing it up to $4,000 or $5,000, depending on your account size. Even smaller sized accounts get a gift too of some cash. Somebody just asked, what's the commission schedule? It's about it's $1 per contract, nothing to close your order. So if you were to bring a position over with option positions over and you close those, you'd pay no commission on those. Stock is free, just like just about every other brokerage firm. But again, go to tastytrade.com and you can see all of their stuff on the site there. Any questions? Because I'm just about done here. Plus my voice is shot. Going once, going twice. All right, I'll take a quick little refresher of the things that we looked at real quickly. I'm going to use the one-day options just so. Thank you, Lisa. Appreciate the kind words. What do we do? Well, I tried to bring it through the progression. I'm just going to click on the 20 deltas and do them quick. We looked at a strangle in the 0 day. I know this is 1 day. We're using $102,000. Our research has shown about $20 wide is what you should be going to here. Again, you'll be using $1,500. We want to be over a probability of profit. If you have over a 65% probability of profit, that's one standard deviation, just a math model. We like to be outside a standard deviation with our risk. If you have a 65% pop or greater, you're doing the right thing. So that's a strangle. Then we looked at an iron condor. I got a question. Could you go $30 wide? Sure. I mean, you could take the numbers and do whatever you want with them. We've just shown that risk from our research, risk versus reward around $20 wide is where you should be. The next trade that I showed you, or combination of trade that I showed you, was selling the straddle. I'll just say the straddle for now, and going to the expected move. I'm going to use the June options again. Expected move is around $100, $110. So we want to go to $100 to $110 out. This would be the type of trade that you think volatility is not going much lower, kind of like what you saw today, where volatility has stayed bid all day long, even though the market is going higher. You sell the front month premium that has to go to parity at expiration, and you go out $100 or $110 wide on your buys. So if we're 52.95, you'd go down around 51.95 or 51.85 if you want to do 110. If you're going up to the upside, you're looking at 54.05 or so. Here you're playing around a $3.25 debit. Again, when you sell this, you'll be selling it for a higher debit if it's profitable. You want to sell it for a higher debit if it's profitable. Again, what I tried to explain to you is the 0 day or the 1 day options go to 0, and these 16-day options hold some sort of premium. The more premium they hold, the better off it is for you. You'd want to put this on when you think volatility is going to stay stagnant or go a little bit higher. If you think volatility is going to contract, you'd be more inclined to stick with just the iron condor, use a significantly less buying power, around $20 wide on that. Got a couple of questions here. Chicago hot today, almost 90 degrees. Yes, it is, Britt. You're not kidding. All right. I think I'm just about done. I'm probably a minute or two early. I'll wait to see if there's any more questions here from me. Let's see if I can stop sharing this. Again, if you do, thank you. Thank you, John. If you ever need anything from me, I'm BAT at tastylive.com. If you'd rather talk to Tom, because it's his name on the door, you can email him, Tom at tastylive.com. We answer all our own emails. I'd love to answer a few. Doesn't matter if you're a customer of Tasty Trade. Tasty Live is always free. So check us out whenever you can.
All right, Tony, that's fabulous. Always do a great job. Very educational. A lot here for basic beginners and seasoned pros like me. So look forward to having you back in the future. And it's 100 degrees here in California, by the way.
You win.
Chicago. But you have the humidity. There, the humidity is intolerable.
Yeah, it can be tough.